Dave, the guys are getting live now, so.
Okay.
Good morning and welcome to Unusual Activity powered by FinancialJuice.com with George Avedon and Milton Marmonides. Thank you for joining us this 30th of January 2015. Certainly a lot happening in the markets this morning. We have a negative tone to the market this morning at futures lower by 21.25 points. Call it 21 handles down at 1997.50. Really looking at that 2000 level once again. We'll get into the technicals with Milton in a little bit. We are very pleased to have with us this morning Dave Landry, and we'll have him on in approximately 15 minutes, so we're certainly looking forward to having a conversation with Dave Landry then. Also, we're taking a look at oil this morning, lower by 2 cents at $44.51 this morning. We have the 10-year now at 1.680. This is something that we have been monitoring rather closely, and the 30-year, we feel the larger story here at 2.263, going below that 2.3 level just a few days ago. So again, a very interesting story there. We have the dollar slightly weaker this morning at 94.712 on the DXY. This is the index, dollar index versus 10 other currencies. Euro is just a tad higher this morning at 1.1326, seeming to be in a particular the 113 handle for the last couple of days. We'll see how that manifest itself in the trading day. Also, one of the things that we are taking a look at globally, certainly a little bit more news out of Russia this morning with respect to rate cuts. Certainly had GDP numbers today. We'll get into those in just a few minutes. Let's get into yesterday's trading day. We had the Dow Jones Industrial Average higher by 1.31% at 17,716.85. The S&P 500 higher by 0.95% at 2021.25, and the Nasdaq higher by higher by 0.98% at 4683.41. If you're taking a look at just volatility and movements yesterday, spent half of the day in more or less negative territory on the SPX yesterday, and certainly moved to the upside towards the close. So we're having a little bit of retracement, quite a bit of retracement this morning. Again, S&P 500 futures lower by about 20 handles now at 1998.50. One of the things, certainly on the geopolitical side, we're continuing to monitor a few active areas on the geopolitical side, certainly in the Middle East, keeping an eye on the ISIL situation, with the death of the Saudi king, looking for rhetoric, looking for some kind of indication from Saudi Arabia, whether or not there's going to be an indication with respect to OPEC. Initially, from what we were understanding, really not much of a change of stance, if you will, with respect to production and OPEC. Continuing here, some of the themes that we're watching this morning is certainly the overall euro weakness for the last several weeks and months. Inversely, we're looking at the strength in the U.S. dollar. Certainly today is a little bit of a correction on that, where actually now the dollar is higher, euro is lower, so a little bit of a volatility there. Oil continues its weakness, again, currently at $44.54, below that 45 mark. We discussed that 44.20 level and a possible 42 level uh, should we go below that 44.20 again. One of the other themes that we're discussing is this notion of deflation risk and how central bankers will react to that in the coming months. Certainly, it has been rather important. It has entered the lexicon of central bankers, of analysts, of pundits. So that's something that we are keeping on a close eye on. The Greek election implication. We're still seeing various opinions on how that may affect overall relations in the Eurozone. Certainly, right now, the conversation of Greece leaving Euro for now has disappeared. Or not disappeared, has at least decreased. Also, keeping an eye on the Russian economy. It's back in focus. We discussed, we mentioned that there was a rate cut overnight in Russia. And again, this is something that we've been discussing for a bit of time, but their economy is having a rather difficult time as of late. And certainly, continuing theme here is certainly the earnings season. And numbers have been rather interesting lately. So let's get into some of the more macroeconomic perspective here. Baltic Dry Index currently at 608 points, falls 3.8%. We have this has been a precipitous decline in the Baltic Dry Index. We'd like to watch, we'd like to monitor this particular index. Gives a great feel of where possible economic activity is, where it's going specifically on containers, shipping containers with respect to grains, raw materials. So that's, again, something very good to watch. On the GDP number, the fourth quarter preliminary number was 2.6 versus the 3% estimated, so a little bit lower on that. Prior was 5.00. If we take a look at the ES futures, we had a little bit of a pop. Well, I'd call it a little bit of a pop in the S&P futures, and then retraced back to the lower levels of the morning after the GDP number. The Q4 employment cost index was as expected on quarter over quarter. And that's at 0.6% versus the 0.6% expected. We are anticipating Chicago PMI at 9:45 this morning as well. Consumer sentiment at 10 a.m. Also, we had, bear with us one moment, we just had the ISM Milwaukee January month-over-month numbers come through at 9 o'clock. That was at 51.6 versus the 58 expected. Previous was 57.61. Also, today we have several Fed speakers for the day. We have Eric Rosengren, we have Daniel Tarullo, and James Bullard. Why do we watch for Fed speakers? We watch for if there's any indication for monetary policy, if there's any indication for opinions on rates. Certainly the treasuries have consistently come down. We discussed this yesterday with Larry Gaines with respect to this notion of this perception of quality on the part of various nations, pension funds, institutionals. So there has been a rather strong bid in the U.S. Treasuries, certainly as of late. And one of the things that we like to keep an eye on was brought up by an analyst some time ago, and this was a very similar situation where a few years back, where the S&P 500 yield, as long as the S&P 500 yield is above the 10-year, you may have a bid in the S&P 500. So again, an interesting dynamic in that. So let's continue a few more minutes with the geopolitical. One of the things that we're keeping an eye on, certainly there's been a little bit more activity between Russia, Ukraine, and really what we're looking for is Russia's response to the West. Should more sanctions come down the line, how will Russia react to that? And specifically, and what we've been mentioning before, is their relationship with China and other countries such as Iran, Venezuela, and other countries. So again, it's something to keep in mind as a caveat as we're talking about Russia. Is remember within Russia, Putin's approval rating is at an all-time high, and that's something to certainly keep an eye on. In terms of continuing themes for 2015, certainly keeping an eye on oil from a also macroeconomic perspective, watching the numbers coming out, and this perception that do we have some currency wars brewing, if you will. So what we'd like to do now is bring Milton in so we can have a conversation about technical analysis, what he's seeing for the markets this morning. Milton, certainly a little bit, quite a bit of retracement this morning. What's on your mind this morning? What are you watching? Let's jump into the technical analysis.
Well, basically, when I came in this morning, George, and we sat down, I even asked you myself what really happened for the markets to be down, 18 plus handles this morning. Clearly, the volatility is here and it's going to stay in the markets. Like many pundits out there saying, what happens in January happens the rest of the year. So clearly right now, January has been a very volatile month. As of now, if we close where we are, we will be down for the month of January. So it could progress into, into February, down the road, the summer months. So who really knows exactly what's going to happen? There's a lot of outside noise pertaining to Europe, Asia, Russia. So we have to be careful when it comes to what really happens during the trading day. We could leave. Yesterday, the futures were, when I left the office, futures were up a little bit, and all of a sudden now they're down, 15 plus handles. So it's a lot of overseas noise to keep an eye on. Just be careful and watch the volatility when you're trading in this market. A few technical things we're looking at. We'll start with the ES. ES, we mentioned for days, the 2000 number seems to be some sort of a magnet for this market. It breaks above it, comes back to it, breaks below it, comes back above it. We're trading basically right at it this morning. We're watching this 2000 level. Spoke to a few other technicals that got people out there. Many have been saying that if 2000 can build some sort of a quote-unquote base level here, the next initial move could be substantial to the up or downside depending on volume. So we're watching this right here. We're watching the formation. It seems like the market is somewhat building a top in a way. The number we're watching for a break below that level is that 1960 low that was hit in the middle of December. We're watching that level. We're watching if that level is broken. We are about 40 handles away, but we are looking down the road. If that number is broken, could see a continuation rollover on the ES. We're watching it here. The volume has been, volume has been there, so it's not a volumeless move to the up and down side. The volume is there, so a substantial move could occur if levels are broken. The levels we're watching to the downside, the ideal levels are that 1960 downside, and the ideal level to the upside is that 2000, 2000 initial 60s, 65 level. Break above that, then we got the previous highs of the 2080s. We could see new highs if those levels are broken. But right now we're watching on a daily basis above that 2060 and below that 1960. It's a large range, but those are what we are looking at on a daily technical look. Intraday wise, we're looking at 2012 to 15 upside resistance to basically right here we are trading right on support. We're keeping an eye on this. We're keeping an eye on levels. We're keeping an eye on the volume and the VIX to give us a better indication of what the direction this market is going. But as of now, we are trading in a range. We are trading with volume. And right now is key to understand that a continuation move to the down or upside could see a substantial move in that direction. So we're watching everything. We update everyone throughout the day if we see anything different. But as of now, 2000 support, 2012-15 upside resistance. If that 2000 support is broken, we are looking at the next level of about 1980s, 1983. Keeping an eye on that. Could be a retest. But those are the levels we're watching. Keep a close eye on that. Keep an eye on the volume. Oil. 30 minutes ago, it was trading up about 50 cents. Now it's back to lows. We mentioned the fact that 44.20 number was broken. So as of now, the downtrend is extended somehow, and we could easily see low 40s to the upper 30s where the ideal support is trading on oil, about 39.40 ideal level. So we're watching oil. We're watching the volatility in oil. The low was broken, hit a low of 43.58 yesterday. We're keeping an eye on this. We're keeping an eye on the direction in which overseas markets are going with either OPEC, any commentary overseas to dictate a follow-on move with oil. Levels on oil we're watching. Intraday level, right around here, 44.20 to 44.40 support. We got the resistance levels about 44.80 to 45.20. It's a tight level range this morning. We're watching everything. We're watching the indications on a break below those levels or a break above our resistance highs. Once those levels are broken, we will update on a next level of support or resistance and make sure we throw it up into the unusual activity link. Next, we have VIX. VIX has been trading in a range as well between that 16 to 20 range, basically. Right now, we are at the higher end of the range on the VIX. Yesterday, we hit the level 20. We've been mentioning for a while. 2021 seems to be the ideal resistance for now. Hit the 2150 yesterday, sold off to about 1876 close. We're watching this range between 16 to 2021. It seems to be trading in that level from the upside. When the upside is hit, it seems to be breaking down to the lows. When the lows are being hit, it rallies back up to the high. So that's the range. We are right now in every market sector, I believe, in tradable ranges. When these ranges are broken, you could see a substantial move because they are building. Volume is building, ranges are building, they're tightening up now. So we're keeping a close eye on the VIX 2021 upside resistance to support between 14 to 16 support. Watching these levels, in the middle you're going to get the gyrations, but ideal, those are the levels we're keeping a close eye on. Gold, what can I say about gold? We've mentioned gold for a while. The 1250 number, prior to it being broken, it was the level to watch. Once it broke 1250, it hit a high of 13 plus. Right now, it's trading back to that support level. 1250 has become support. 1300 has become resistance again. In that tradable range, 1250 was traded basically to that level yesterday. I believe it hit like 1252, 53 on the trades. So we're watching those numbers. We're watching those levels, keeping a close eye on what exactly the market sees into the trade in gold. 1250 support, 13 resistance. Volume is there. The volume is there to substantiate a move higher or lower. So we're keeping an eye on both levels. Lastly, it's currencies. In my opinion, it's all about currencies right now. You had Russia come out, cutting their rates again. The ruble. It seems to be a everyday thing. Every day we're hearing about another country cutting rates, trying to quote unquote manipulate their currencies. It's clearly is it a negative to the U.S. dollar, the strength? It could be to companies reporting overseas. Many company on earnings reports have mentioned the forex currencies, the gyrations, how it affects their earnings. So that has to be something to watch. The dollar is trading at highs. The euro is basically back to lows. Keep an eye on currencies. Keep an eye on these markets. We're in a very tight range, And as of now, clearly we're trading inside that range. But if we see a break above anything else, we will make sure to let everybody know. George?
Milton, thank you very much. So, folks, there you have a macro view of the technicals from S&P to oil, gold, and the dollar. We are very glad now to bring on Dave Landry from DaveLandry.com, who's been in the industry for quite a while. We are very happy to have him on. Dave, thank you for joining us this morning. So if we could, Dave, introduce yourself, give us a little bit of a background on what you've been doing, and we'll go from there.
Okay, fantastic, George. Thanks for having me on, and thanks to Financial Juice for having me on too. As you mentioned, I have been trading for a very long time, probably over 20 years. I've been posting internet-based commentary since the late 90s on the retail side, and I also have worked on the institutional side for quite a bit. I was a commodity trading advisor, registered CTA for over 14 years. Personally, and on the retail side, I trade stocks mostly. I do trade occasionally Forex and some of these other markets. I find they're more efficient, and you have to pick your spots very carefully in those type of markets. My goal is to find inefficiencies in stocks, such as IPOs, maybe smaller cap stocks, such as a little hot and upcoming biotech stock that has the potential to make a large move. As far as my philosophy, I think you can only predict so far out when it comes to the markets. Whenever I do a presentation, I throw up a big disclaimer screen, which is kind of the boilerplate that everyone uses. And then my next screen, I said, instead of reading all those warnings, just know that all predictions are about the future, and a lot of stuff can happen between now and then. It's kind of analogous to looking outside, and if it's cloudy and thundering, you know that it's probably going to rain pretty soon, but you don't know if it's going to be raining this time next week or next year. So I'm very adamant about the fact that you can only predict so far out when it comes to a market. So I'm a short-term trader, but that doesn't mean that I won't hold positions longer term. Sometimes I'll hold positions for weeks, months, and then occasionally, not that often, but occasionally I'm able to hold positions for years. So I'm slotted as a short-term swing trader, but the reality is I'll stick with it as long as it moves in my favor. Now, the problem with long-term trading, like I just said, it's hard to make those predictions. Your stops have to be incredibly wide. You hear about these famous, world-famous trend followers, and what you fail to hear about how much money they make and how great they do. What they fail to follow up on is a lot of these guys subsequently blow up. So it's very dangerous to trade longer term. But I believe if you could take a hybrid approach and get the short term right, take a short-term profit, and then trail a stop and let that stop slowly loosen up, you can stick with that position for as long as it moves in your favor. Because the real money isn't a longer-term trend, but it's very hard to predict that trend out weeks, months, and even years. But there's nothing wrong with following the trend. So I am a trend follower. Again, short to intermediate term is my time frame, but I'll stay with the position as long as it moves in my favor. People ask me, what's my holding period? I say I hope at least 10, no way, 20 years, but the reality is the money management will take me out much quicker. I like to trade reversion to the mean in the direction of the trend, and that's a fancy way of saying pullbacks. I also will trade emerging trend patterns where a market begins to bottom out. For instance, some of your currencies are beginning to top out a little bit. I'll look for some sort of emerging trend pattern off of major highs and major lows, and that's especially true in these more efficient type of markets. Again, I trade mostly stocks, looking for inefficiencies. I'm a pullback player as a general statement, and I'm looking for that quick little pop, that quick little reversion to the mean, so I can get a quick little swing trade profit off. Then I can bump my stop up on the remaining shares and hopefully trail that stop higher for a long, long time. A couple of more thoughts. I believe, of course, in trading with the trend, we're trend followers. Very important to trade in the direction of the trend. Don't fight the trend. Don't try to pick bottoms. Don't try to pick tops. As I say quite often, as trend followers, we're going to be a little bit late to the party, and that's okay. So basically, my philosophy is the trend is your friend, and I believe in keeping things simple. I think all traders go on a big holy grail hunt, present company including, and it took me a long time to peel away all those indicators and oscillators and everything and just get down to the true essence of the markets, and I believe that's price and what price is actually doing, and price and only price is what I trade off of. Occasionally I will use a moving average. I have one or two moving average patterns that I use, but for the most part, probably 90% of the time, I'm working off a blank chart, and again, I keep it simple. So a little bit of a long-winded answer, but in a nutshell, that's pretty much it. The rest is just a few little details, and that's my entire methodology right there.
No, Dave, we appreciate that. You know, it's interesting that you say that a lot of the pundits and analysts and portfolio managers, you know, we've always noticed, you know, we've been in the perhaps we're a few, maybe a couple of years shy of 20 years as you are. We've certainly been around since the mid 90s, and one of the things that we pull out is. You know, I want to say this in the most layman way possible at the same time keeping it professional, but you know, a lot of folks you know, want to go out there and you know, and tout their own you know, portfolio and so, but the reality is you know, they don't follow up on how their portfolio is doing in a few years and so forth. So we definitely believe that having a thought process behind trading, we definitely feel that having a at the same time short-term and long-term outlook, and I'm so glad you pointed to that. We're more on the short-term and the long-term, where we're including both technical and fundamental data. As I'm sure you know, we follow news quite a bit. And the implication of certain data on price movements, specifically price action, and specifically volume. I couldn't help but notice, you know, I read your early morning blog this morning, the random thoughts about the preacher, and I thought that was very apropos. And you know, look, I think if you stick to your guns. You know, there's a methodology that can be developed. So I think that, you know, we totally agree with you on that end. I'd like to ask you if we can jump into this particular market. What is your feel on? You know, certainly we've been range bound, right? I mean, let's go macro level first. S&P 500. What's your feel on this? Give us your take on, you know, January 1st. So it certainly has been you know, our opinion is January has been just rather volatile, right? I mean, a lot of news, lots of going on, currencies, government, so forth. What's your take on current volatility? Can this volatility continue for the rest of 2015?
Well, I've got quite a few thoughts. One thing you said, first of all, we are in a range, and one thing that people forget about is technical analysis in its most simplest form is looking at where's the market now and where was the market. Now, this open notwithstanding, if you go from yesterday's close and you go back in time, you can go all the way back to late October of last year, and the S&P 500 is essentially unchanged. So we're seeing some volatility, but the volatility is within that range, and it's kind of interesting that there's a lot of things that are unfolding here, and somehow the market has stayed in the range. So, not to get to the micro too quickly here, but if this morning's weakness holds, if we have like a big opening gap reversal, we may have dodged a bullet. But I think we do need to watch the bottom of that range, which is about 1975. Now, what's kind of interesting is the 200-day moving average is also there, and I don't use moving averages that often, but sometimes I think they can be relevant, and I know that the 200 is well watched by a lot of people, and
no doubt.
And yeah, absolutely, and sometimes it becomes a self-fulfilling prophecy. Now, what's kind of interesting about technical analysis, at least when you keep it fairly simple, that is, a lot of technicals will come together at the same point, and we used to joke years ago that it's like the thermos. It keeps the hot things hot and the cold things cold. It's an old Cajun joke. How do it know? And it's like somehow it's like, how does the market know that the 200-day moving average is going to be right where that support is? So you have a few things coming in. Everybody and their brother is watching 1975. I think that one of the shows that you were on recently that I was on with you, George, we because everyone's watching it, as somebody pointed out, we could easily have a big stab below it.
Right. Right.
and then pop right back, just because everybody in the world thinks it's going to be the end of the world. And one other thought too, it seems like with this market, and I know there's a lot of good reasons why the market should be going down. And Schaubacher once said, he's a famous technician, you're familiar with him, I know. He said that fundamental analysis, and I guess you could throw the news in there too, is what a market ought to do, and technical analysis is what the market is doing. And I know you guys use that news to your advantage at a usual activity when the news and the markets are reacting in a certain way to the news. So you have to, ultimately, you have to keep an eye on price and not make big picture predictions. And as a trend follower, I'm looking at the market. It's either going up, down, or sideways. And if it's going sideways, I need to be sitting on my hands and risk that temptation and resist my ego to go in and make a big picture prediction and just let things unfold. So I forget what the original question was, but that's kind of a long-winded answer to it, I'm sure.
No, you bring up a good point, and there we have the New York Open there. You bring up a really good point, Dave, and this is something that Milton and I talk about constantly, is this notion of that if a particular level is so closely watched by everyone in the industry, from institutionals to hedge funds to your professionals, semi-professional traders to active investors. I mean, clearly, you almost have I don't want to call it an exaggerated move at a particular level, but it's. Let me ask you this: how would you? You've certainly been in the industry for a long time. Highly regarded. Let's, should we go down to 1975 and the market reacts to that, how would you, as a trader, respond to that? What's that follow through? What do you want to see, whether it's on the downside or the upside?
Okay. First of all, I'm not that short-term oriented, unless sometimes the market will give you a gift, and I think Jimmy Rogers once said, I think he said it at Market Wizards, that he waits until there's money in the corner and he walks over and picks it up. So every now and then you'll get a nice opening gap reversal or something where I can't resist the temptation to go in and pick up a few nickels, and that's not the crux of what I do. So I think that if we do have some sort of scenario, big gap below that well-watched 1975, then maybe I might go in if I see some little intraday reversal. But again, that's not the bread and butter. What I do to approach the markets is I look at roughly about 2,000 stocks every night. And to those of your clients who are interested in trading stocks, I think it's a wonderful exercise. You have to put your time in, and that's one of the complaints somebody said about my book on Amazon. They said that it's too much work, and it is a lot of work. And if you want to succeed in this business, the true reality is there is no magic bullet, there is no holy grail. You're going to have to put your time in. Like you guys, you're gonna have to have, pardon my French, you're gonna have to have your ass handed to you a few times to make you realize that stuff, it happens. Spelled with a silent sh, and so you have to be around the block, go around the block, or time or two. Sure. When it comes to markets. But anyway, through looking at all these stocks and doing this work, empirical work, or just a simpler way of putting it is just looking at stocks, I get a really good feel for what's going on. Now, right now, so the question is, so what's going on, Dave? Well, right now, it's just choppy. I'm not seeing that many setups. I'm seeing a few setups in the gold stocks and the silver stocks, but so far we really haven't seen any meaningful follow through there. There's been a few little IPOs that have taken off, some biotechs have taken off here and there, but for the most part, there's not a whole lot of action that needs to be taken. And I preach over and over again to listen to your database, and if you start looking at that many charts every day, after a while you'll get a feel for what's going on. And right now, it's just choppy, and I'm not seeing a whole lot of setups, and that's telling me to just sit on my hands and let it unfold. So as I've been preaching quite a bit, you need to wait and not anticipate with this market, because let everybody else find it out. So every time we get a little dip, like if today we close lower, I'm going to get a half a dozen emails telling me that it's the end of the world and the market's going to crash. And then 2 days from now, the market will bounce, and they'll wait. A few days later, the market will go down again on another email. So I think the bottom line is, this is a market where you don't want to make any big picture predictions. You want to pick your spots really carefully. Like I tell everyone, if you really, really like a setup, you think it's the greatest setup in the world, then by all means take it. regardless of the market. But for the most part, just pick your spots very carefully, and make sure you think that you have the best setup in the world, and don't make these big picture predictions.
Sure. No, and David, we're part of the same camp where, especially in a range-bound market, and in the proverbial churn, if you will, in trader talk, a little bit of patience and a little bit of thought process has to go into
Absolutely.
establishing a particular trade. One more macro question I'd like to maybe dive into your thoughts on the current earnings season. Certainly, we've been talking about a trade, whether you're looking at the S&P or maybe even if you're taking a look at oil specifically. But are you looking out for any specific indication as it relates to having the market get out of this particular range? I know you monitor technicals quite a bit and so forth, but is there anything that's kind of I don't want to say devil's advocate or anything that's saying let me at least keep this on the back burner should something bubble up. I'll be sure to at least establish a trade on the downside or the upside.
Okay. First of all, just to backtrack on what you said about being in the range and the churn. In yesterday's column, what you guys had picked up on financialjuice.com, and I appreciate you guys picking that up. I said, this is a Livermore quote. You always get some good wisdom out of Jesse Livermore. He says, remember this, when you're doing nothing, those speculators who feel they must trade day in and day out are laying the foundation for your next venture. You will reap benefits from their mistakes. And I often tell people we're more waiters than we are traders. If you just sit around and wait, the market will eventually come to you. And I think that's where we are. Now, your question is what type of indication? The whole world's watching 1975, so again, so am I. In trading, as I said earlier, you don't want to make these big picture predictions, but that doesn't mean that you shouldn't come up with some scenarios, okay? A market could do whatever it wants to do, and I think it's important for you to come up with a few scenarios and then let things unfold and see if those scenarios plan out. It doesn't mean you should rush out and guess ahead, but you have to come up with scenarios. And I think one scenario could be, as we mentioned earlier, as we stab down below that 1975, scares a lot of the longs out, attract these eager bulls, which bears, which seem to be waiting in the wings. Again, on every downtick, they seem to want to call the mother of all tops. And I think, again, that we could have this sort of a vacuum, for lack of a better word, below 1975, and then it comes right back up and through the range. Now, that's just one scenario. Without trying to think too much, if we do break down below 1975 and we stay there, one thing I've learned just empirically throughout the years is if you have a base and that base gets broken and then it comes right back into the base, it's like traders or maybe even investors don't have time to react, and they feel like, okay, well, everything is just fine, we're still in the range, and they don't take a lot of action. But if you get below that base and you start staying below that base, it puts pressure on the participants who bought during that base. Now, keep in mind that my approach to technical analysis is very simple. I'm just trying to read the psychology of what's going on in the market. And the longer you stay below that base, and then the further you get below that base, the more and more people begin losing money. And Technical Analysis 101 says that range above the market, that base that we just broke out of, or the range that we're in now, if we get below it and stay below it, it's called overhead supply. So those people who bought in that range, it's just simply human nature. They're going to want to get out and break even. So that's going to sort of put a roof on the market if that happens. And it's four things that I'll be watching. I'll be watching moving averages to see if they cross over. I have a pattern I call bow ties. Usually if you get a bow tie off of major highs, it can signify a fairly significant top. All major tops will have that pattern, or will have some sort of other emerging trend pattern in them. And it's not complex patterns, just simple patterns like what I call a first thrust, where you get a market that just made recent all-time highs like the S&P. you get a significant breakdown, it pulls back a little bit, and then you get that next leg down. So if those type of things begin to pan out, the longer we stay below the base, and again, if we don't have this dip below it and come right back up, that would be a major concern for me. And the further we stay below the base, because right now anyone who's bought above 1975 is profitable. And if you go back in time, that means anyone who's bought this market from late October till now is not, I wouldn't say profitable, but they're above 1975, they're profitable. Now, as soon as that drops below that, you've lost 3 months worth of trading. Over 3 months worth of trading, and so anybody who bought those 3 months is going to be hurting. And then the further you drop below that, you have a lot of trading at like 1950, and then you just keep dropping the bar further and further down. So anyone who bought going back to, let's say, last summer when you get to 1950, they're going to be more and more inclined to get out of the market because they're beginning to see their profits evaporate. Now, one last point to remember is this market has just gone up since 2009. We've had some pretty serious shakeouts along the way. We've had some pretty serious sell signals along the way, and the buy and hold guys have completely ignored those sell signals. And I think one of these times, one of these sell signals is going to work. I hope the market goes up forever, but I'm very pragmatic. I'm very much a realist, and I'm gonna watch to see if we break. Just to close it up, I'm gonna watch to see if we break below that base and stay below that base, and then at that point in time, I will look to start establishing shorts. And I'm going to let the database tell me what to do. Right now, I'm not seeing any setups because the market's going sideways. But if that breakdown begins to hold for a period of time, I'll begin to see a plethora of shorts, and then I'll position accordingly. I'd rather just go long and stay long forever, but the reality is you have to play the hand that's dealt.
Sure, no doubt, Dave, and I think you bring up some good points. When you initially, and thank you for that explanation. Certainly provides a lot of color with respect to perhaps directional trades. One of the things that I think you brought up is rather poignant, and that is this notion that there's a lot of potential short sellers out in the market, especially on the macro market. We actually feel that can be actually a contraindicator, almost a contraindicated with respect to where the market can be. So as long as you have a bunch of shorts out there and waiting to pounce on the possible short, that may be a kind of a almost a contraindicator for an existing bid in a way, because as you know, in trading, if you have a bunch of shorts out there, you could have a bit of a short squeeze, and that can certainly point to an interesting dynamic.
And like you said, that the vacuum dynamic where we probe down way below that 1975, there's so many eager shorts out there. That's going to give like the all clear to them. And it's interesting that you point that out, because you're right. And if that market does not follow through from that, then they're going to be in trouble when they have to buy back. I didn't mean to cut you off. I just want to. That's one of the problems. You and I have been on shows before, and the complaint is that there's not enough controversy. So I fully agree with you on that. So I'm just trying to chime in and agree with you.
Yeah, no, absolutely. Let me ask you this, Dave. Let's jump into how do you give us your opinion of how. I mean, I know again you're steeped in technical analysis. What's your view on the current earnings environment? Certainly earnings season. Do you trade based on earnings? I know you're into mean reversion. Is this something that perhaps maybe a how do I say this? Let's say earnings come out and there's a rather severe reaction to a particular equity. Do you take that as an opportunity perhaps to revert back to the mean?
No, and the reason is that I do trade reversion to the mean, but that's only within an established trend, so it's got to be in a serious uptrend. Now, I believe that surprises generally happen in the direction of the trend. Yes, I get whacked every now and then. Because I do ignore all news, I just ignore. You have to take an all-in-one approach. I think you either have to factor news into your trading, and I love some of the stuff you guys do at Unusual Activity. I find it fascinating. It's a little bit more short-term than I'm used to, just because I guess I'm getting a little older now, and I'm just trying to take a little bit bigger, longer term positions from these shorter term positions. But I ignore all earnings announcements, and the way that works for me is that I think if you pick and choose, you end up picking the right ones and the wrong ones, and picking the wrong ones and to think it out of the blue here, but like NVRO, and this is a stock we're long in the portfolio for full disclosure, but it's set up as a nice IPO pullback, and it kind of flatlined for a while. I didn't do anything right, I didn't do anything wrong after it triggered, and then recently there was some news that floated to the market, and the stock jumps about 10 points or so on that news, about a 25% jump overnight. So that's the kind of surprises that I like that happen in the direction of the trend. I think if you were to trade news, I think maybe take a little bit of a contra approach, and I think that what you guys are doing is wonderful, because somebody asked me a while back, like, well, what's going to happen when Steve Jobs dies? I was in Dallas at a presentation, and I said, well, let's just see what happens in the market. Let's not worry about Mr. Jobs' inevitable. At the time, he was very sick. And I said, but what you do is see where the stock trades after he dies, or on the announcement of the news, and then buy it when it trades back up through that level. So it's almost like if you take a little bit of a contra approach to the news, I think that's a great way to trade. If I was a little younger and more active like I was 20 years ago, I think that's one of the things I would factor into my trading. So I ignore the earnings season. I don't worry about it. It's the reaction to the news that's important, and not the news in and of itself.
Absolutely, it's certainly the price action, Dave, and we want to just we did have some breaking news here. Chicago PMI at 59.4. We currently have the futures are lower by 8 handles now at the 2011.5. So again, as we've been discussing, that 2000 level. Certainly an interesting level maintained there. Again, a little bit of a lift off in the futures now, lower by 6.5 points at 2012.25. So we'll see if there's a continuation of a little bit of reaction based on that Chicago PMI. So, and again, we're coming up to on specifically the S&P 500 futures. We're coming back to those at least at intraday resistance levels. Dave, I think you bring up great points with respect to actually the price action. This is what we concentrate on. Rather seriously, specifically on what's the news and how it's affecting price action, and specifically on the volume follow through there, no matter where that information is coming from, whether it's option based or data based, social media, specific news, what have you. So this is something that we're keeping an eye on rather closely. Give us an indication. Certainly we're already into the market, would have a little bit of a let's call it a bit of a recovery from the lows of the morning.
Yeah.
Give us a send us off here a little bit. What you're watching out for today and over the next few days. And technically, if anything else that's on your mind for the next few days.
Okay. As you probably know, or as I know you know because you've been around, in bear markets, bear markets start strong and then they finish weak. And bull markets start weak and finish strong. So today's action so far, we found a low within the first few minutes of trading. So far so good. We dodged yet another bullet in this range that we're in. So as far as the sending off thoughts, just continue to watch this market as long as it remains range bound. Just put a horizontal line in the middle of the trading range, and one on the top and one on the bottom, and look at where the market is and look at where the market was. And until we get out of this range, pick your spots very carefully, meaning that, again, we had some setups in some gold stocks. We like those stocks for now. If they don't pan out, they don't pan out, no pun intended. It is what it is. Put a stop on every trade just in case. But be very selective as long as this market remains in a range. You don't have to be in there every day trying to fight it out. Let everybody else fight it out, like I said earlier, quoting Mr. Livermore. And I think that's good advice. Is just sit and wait and let the trades come to you. Wait until you have a good setup, and If you're not seeing any setups, wait at least for this market to get out of this range before getting too excited one way or the other.
Yeah, no doubt. Watching that churn level. Certainly, Dave. Thank you so much for joining us. We hope to have you on again. You're certainly a wealth of knowledge and experience, and some folks we like to speak with often. This has been Dave Landry from DaveLandry.com. Thank you, Dave, for joining us on Unusual Activity. What we'd like to do please stay on. We'd like to actually run through a couple of news items that we've been seeing this morning through the early morning hours and into this morning. First, we'd like to dive into specific stocks that have been circulating around desks this morning. Bear with us just one moment here. So some thoughts on Alibaba. BABA should be bought on weakness according to Specific Crest. CNX Consol Energy Q4 earnings per share of 25 cents versus 20 cents. Revenues of 935 million versus the 958 million. We can take a look at Alibaba this morning, certainly. Alibaba this morning at $88.57. Again, Pacific Crest commenting on them. Also, CNX currently at $97.07. ICPT, we had a target cut to 475 from 500 from JMP. ICPT currently at $204.06. Amazon AMZN, bear with us as we're a slight delay on this. Amazon price target raised to $410 from $389 at Credit Suisse. Groupon upgraded to buy from sell at Ascendient, and this is something that we're keeping an eye on. Folks, Amazon currently at $347.04. Taking a look at Groupon this morning. Waiting on that data. CTSO, Cytosorbents, announced an exclusive distribution agreement with Aferetica SRL. Celgene, CELG, price target raised to $145 from $131 a Cantor. Deckers Outdoors, long-term fundamentals on track, says Citigroup. We can take a look. Currently, Groupon as it's $7.33. So again, upgraded to buy. So let's jump into a few more things that's perhaps impacting markets this morning with respect to earnings. QLogic upgraded to outperform for market perform at BMO Capital. Posted third quarter profit of $22.4 million. Results tops expectations. Yahoo, a lot of conversation about Yahoo, where directionally, where it's going, and we'll certainly keep an eye on that. Yahoo upgraded at Evercore to buy. Eli Lilly beats by 2 cents, misses on revenue. LLY. Chevron takes a 2015 exploration budget, cuts 2015 exploration budget by 13% to $35 billion. Folks, this is something that we were discussing several weeks ago, folks, and it's the implication of and the effect of oil being this low for so long. It's going to affect CapEx fundamentally, and out of the S&P 500, 40% of the CapEx is from the oil names. So that's something that's really important to keep an eye on. We've been talking about this for several weeks, and now we're beginning to see some interesting news coming out from there. From an insider transaction, we'll pick out some of the larger ones. ML&K, we had a large 10% owner purchase of $500,000 purchase in ML&K. We had NHF, Next Point Credit Strategic Fund. We had a affiliated person purchasing over $1 million worth. WYY, a smaller purchase, 44,000. VSAR, Visardis, we had a let's call it an aggregate of $5 million insider purchase overnight into this morning. Also, we had a Bank of New York Mellon BK director purchasing $10 million worth of the security, and also a rather significant purchase in Microsoft, certainly a widely held security, at $1 million purchase. Want to get into some of the syndicates this morning. As you know, syndicates are, it can be secondaries. There's various filings. You'll see perhaps a mixed offering, mixed filing, where it can be a common preferred debt, and so it can be an overall mix. So again, we'll go through some of these. AHT files to sell 9.4 million shares of common stock. AVGR 5 million share IPO priced at $13. IGC India Globalization Capital files to sell 1.2 million shares of common stock. HIFR 20 million share IPO priced at $23. PFMT Performance Financial withdraws common stock and convertible offering. Shake Shack, we know that's been discussed, 5 million share IPO priced at 21. So we're getting now indication of Shake Shack of $42 to $44. Officially, it would be 100% pop, and that's SHAK. This is a tweet from Carl Quintanilla. Spark Therapeutics ONCE 7 million share IPO priced at $23. TCON 3.6 million share IPO priced at $10, and UNIS announced a common stock offering, no amount given. We had a few share buybacks. CB 1.3 billion share buyback. GHM approves 18 million buyback program. DEC we mentioned before. 200 million buyback program. RUSHA adopts a $40 share repurchase program, and PII 4 million share repurchase. So, folks, let's have a quick recap of where we are this morning. S&P futures are down 7.75 handles, 7.75 points at 2010.75. Certainly back above that 2,000 level that we've been mentioning earlier in the morning. Initially, we had a rather significant risk-off trade in the morning. We can take a look at oil this morning as well, above that $45 at $45.29, higher by 75 cents. Very interesting dynamic there. We'll see if that holds that 45 at least for now. And folks, the larger story here that we'd like to always monitor is this yield curve in the U.S. 5-year 1.205, the 10-year maintaining that below that 2% at 1.685. Now, really below that 1.8 level. We'll see if that is able to be maintained. And the 30-year, the larger story here, is the 2.254 here, folks. And if you're taking a look at the yield curve, you monitor that rather closely. We have a flatter yield curve as opposed to a year ago, and typically flatter yield curve is not quote unquote indicative of a rather expansionary environment. So again, we know that the central bankers watch that rather closely, and so as do we. So folks, thanks for joining us on Unusual Activity, powered by FinancialJuice.com, with George Avedon and Milton Marmonides, with our special guest Dave Landry. Thank you so much for joining us from DaveLandry.com. We wish you a great day and good hunting.
Thank you, George. Thanks for having me on.
Pleasure.